In this video, we're going to be looking at the Chapter 4 Practice in Class Assignment problem 54. And so we have a consolidation with an intercompany sale of equipment using the cost method. Go ahead and pause the video, read through everything, and then come back and we'll just dive right in. Okay, so you've already read through this. We're going to start by just kind of preparing our AAP information so that we have it ready. And so first we're going to just get the annual depreciation for each of these items. The very first one, the accounts receivable, is a little bit odd because it's entirely taken care of in the first year. It says collected year 1. However, that's still included in our cumulative AAP. So we do want to pull that over, but it's not going to have like an annual reoccurring depreciation. So I'm just going to leave this blank. Then I'll go ahead and just do our normal 75,000 divided by 10. The 120,000 divided by 8 years. Goodwill is not going to be depreciated. And then we can do the sum function and total up so that we can just get our annual depreciation amount. Then when we're looking at the cumulative through end of year, we're starting at January 2018, coming all the way up to 2022. And so if we're looking at end of year, we need to multiply this amount by 5. So I'm going to say equals the annual depreciation times 5. Pull that down. Copy this formula to the right to just sum all of those up for us. Then if we're going to take the carrying value, it is the original allocation minus the AAP up until this point. We can pull that down. And then also, if you're interested in calculating the AAP through beginning of year, if you want to just go ahead and do that now, you can. And so that instead of looking at 5 years, it's only 4 years have passed. And so that would be our annual depreciation times 4. Pull this down. We do still need this 15 to come over because it is still applicable to the AAP, cumulative AAP through the beginning of the year. And then we'll do the sum this. And so we have 105,000 total for beginning of year. We will need that for our adjustment entry. So having that ready is just kind of helpful now. If we jump down into the intercompany sale portion of this, we have some additional information. So the parent sold equipment to the subsidiary for $148,500, but the original cost to the parent was $144,000, and the parent was depreciating it over 12 years. They've already depreciated 2 years. The subsidiary is going to depreciate it over the remaining 10. So that's going to create a difference in depreciation that we're going to have to account for in our consolidation process because we need it to look like this transaction never happened. That's what we need to communicate after consolidation takes place. So let's go ahead and calculate that difference. The parent's depreciation was their original cost divided by 12 years. The subsidiary, however, is going to be depreciating the cost to them, the $148,500 divided by 10 years. And so when we do the subtraction here, we see the difference of $2,850. And that is going to create a difference that we're going to have to eliminate or reverse in all of our consolidation process. Okay. Then you can scroll down. There's the financial statement information. Go ahead and look through that. And the very first task is for us to record the journal entry on the date of sale for the parent, the subsidiary, and what the I entries looked like that very first year. So by completing these journal entries, we get a kind of a snapshot of what it looked like from every angle, from the parents' books, the subsidiaries' books, and then also in the consolidation process for that year of sale 2020. And then we're going to move forward and actually complete the consolidation, what it looks like in the year 2022. So starting out, the parent received cash. They eliminated the accumulated depreciation that was existing, and they also eliminated the equipment. And then it's going to end up creating a gain, but we'll leave that blank just in case it happens to be a loss. So if we come up and get the cash that the parent received was $148,500. As far as accumulated depreciation goes, they were depreciating it at $12,000 per year, and it told us that 2 years have already taken place, so times 2. The equipment that we're eliminating is the $144,000, and so we can see here that that does end up creating a gain of $28,500. So we'll put gain on sale right there. For the subsidiary, they just received equipment and paid cash for the $148,500. And then we have to do these 2 I entries that deal with what the consolidation looked like the year that this sale took place. So first we're going to reverse the gain and then restate the equipment and the accumulated depreciation to get them back in place as if the sale never even happened. So first we'll debit the gain on sale, and then we're going to need to credit both the equipment and our accumulated depreciation. The gain on the sale is this $28,500. We're going to reestablish restate the accumulated depreciation for $24,000. And then the equipment, of course, we could just do the difference and we get $4,500, but also you can see it right here that the difference of the sales price versus the parent's original price is that same $4,500 difference. So that was the write-up that took place that we're reversing in this journal entry. And then finally, we also have to eliminate the excess depreciation that happened because the subsidiary is depreciating at a greater level than the parent would have been if the sale didn't happen. So we have to eliminate this $2,850 of excess depreciation. We'll do that using the PPE category and depreciation expense, or possibly operating expenses, depending on, most likely operating expenses is where this would have already been like chunked into. So let's just say operating expenses. For $2,850. Okay, that's just slow. There it comes. All right. Then part B is asking us to calculate the remaining deferred gain. And this is because that excess depreciation, we recognize the gain by that amount every year. And so at this point, how much of the gain is still deferred? And so we'll start with our original intercompany sale. Since we already have the gain right here, I'm just going to reference that rather than jumping all the way up to the top. Then our annual depreciation adjustment is this $2,850. How much gain has been confirmed? And so that's 2 years. So we'll take the $2,850 and times it by 2. And so then the amount that is still deferred would be the $28,500 minus what we have confirmed. That's the confirmed gain. And so that leaves $22,800 left unconfirmed. Part C asks us to calculate the net income had the parent used the equity method instead of cost. And so we can go up and get the subsidiary's net income of $112,500. And then we're also going to take into account the deferred gain. So this $2,850. And then we'll subtract out 1 year's worth of AAP. So, $20,500. And then when we do a sum here, we get $92,850. Part D is asking us to calculate what the equity investment balance would be if the equity method was used. And so let's go get our common stock end of year. And I'm going to Command D to just copy that down since we're looking at end of year, it's just right below it, so that works out. Then at the end of the year, the unamortized AAP, and so we'll go hop up, and we already have that up here. This carrying value, the $217,500, and then finally, we need to subtract out the unconfirmed gain. But keep in mind, this is at end of year. So previously, we had identified 22,800 as unconfirmed at beginning of year. So that means we need to take that number and subtract out one more year that has now been confirmed. And then we'll do our sum. And we have 1,082,550. So we've answered those questions. Now we're getting to actually doing the the consolidating process. And so we need to start with this adjusting entry to get us from the cost method into the equity method. And I gave you space over here for us to calculate what that adjusting entry should be. So first, we're going to calculate the change in retained earnings from acquisition through beginning of year. And so if we come up here, we have beginning of year retained earnings of 375,000 for our subsidiary, minus, if we go up to the top, retained earnings of 165,000, and so we get a difference of 210. Then we're going to subtract out the cumulative AAP, so I'm going to say equals negative, and I made this note that this also needs to include that accounts receivable amortization from year one. We did already include that up here, and so we can just grab this 105, and this is beginning of year. So that's part of why we went ahead and just did that right out the gate so that we had that number ready for us. And then we also need to grab our beginning of year downstream unconfirmed asset. And we already calculated that over here. So I'm going to put a negative sign and then grab this 22,800. And then we'll do a sum. And we can get the total of 82,200 is what we need to adjust for. So to actually record that, we will debit our equity investment. And this is boy, if you like to put that note to yourself. And then we're going to credit retained earnings for 82,200. And so now we've been caught up to the equity method, and now everything else essentially looks the same, but we'll go ahead and dive into it. So on our C entry, we need to eliminate both the income from our subsidiary and the dividends. And when we come up, we'll see this income from subsidiary 52,000 matching with the dividends 52,500. So that's taken care of. Then we need to eliminate the stockholders' equity, and this one only had common stock and retained earnings, and those are going to be eliminated through the equity investment. And we'll grab those. We have common stock of 450,000. This retained earnings is our beginning of year amount, so we'll go get the 375,000. Add those together. Then we now need to recognize our unamortized AAP, and so we're kind of just explaining our AAP and pulling it out of equity and explaining what it actually is. So I'm going to, I was going to cell reference these, but it's actually kind of ugly because it has those words with it. So instead of cell referencing, I'm just going to type PPE, patent, goodwill, and equity investment. And this is going to be a value that we didn't even put here because this is the end of year amount and we actually need the beginning of the year amount. And so we can, however, we can just like get to that by adding 1 year back to this. Or if you wanted to, since we did the AAP through beginning of year, you could take the original cost minus the AAP through beginning of year. And we get 45,000, and then we can pull that down. And I just want to go double check the 135. Okay, great. Just since I just want to make sure I didn't mess up that formula. But so that's good because there is no amortization to the goodwill. So we wanted to pull that number straight down. Then we'll do a sum here for 240,000. Then to our D, we can deal with the depreciation. So we'll put this in our operating expenses, and we will now do our PPE and patent. And this is now for 1 year, which we calculated that annual amount. And so we have 7,500 and 15,000. We'll add those together and get that annual amount that we've already seen before, the 22,500. Now we can hop into the I entries. This is very similar to what we've already done above. However, the gain has already been closed out to retained earnings, so for our subsidiary. So instead of us debiting gain on sale, we're going to debit equity investment. And we're going to credit PPE. And that's going to be for our gain. And we're going to do this remaining gain, the 22,800. And then the depreciation adjustment looks very similar, where we're very similar to what we did before, I'm trying to say. And so we're going to debit PPE and the operating expenses for that difference of 2850. And now we have all of our entries done, and we can just go ahead and post those down below. So I'm going to pause the video and go ahead and post mine so that you don't just watch me going back and forth, and then we'll look at the end values. Okay, so now all of these are posted down here, and you can do like a quick reference to just make sure that you have the same things in the same places. It's really just a matter of going back and forth and plugging all of these down into the worksheet. So, but if you want to pause the video and just check your balances, feel free to do that.